Most people walk past wealth every single day without recognizing it. Not because it is hidden, but because nobody ever took the time to explain the system that creates it. The stock market is one of the oldest and most powerful wealth-building mechanisms in modern economic history, yet the majority of people interact with its consequences in their pension funds, in the prices of goods, in the rise and fall of entire economies, without ever truly understanding what it is or how it functions at its core. At its most fundamental level, the stock market is a marketplace where ownership in companies is bought and sold. When a company decides it needs capital to grow, to hire more people, build new infrastructure, or expand into new markets, it can choose to offer portions of itself to the public in exchange for money. These portions are called shares, and the act of offering them publicly for the first time is known as an initial public offering, or IPO. According to the U.S. Securities and Exchange Commission, once those shares are issued, they can be traded freely between investors on exchanges such as the New York Stock Exchange or the NASDAQ, where prices shift continuously based on supply, demand, and the perceived future value of the company. What makes this system psychologically interesting is that when you purchase a share in a company, you are not simply handing money to a corporation and hoping for the best. You are becoming a part owner of that business, however small that ownership may be. If the company grows, becomes more profitable, and increases in value, your share of that company grows with it. If it shrinks, your investment shrinks accordingly. This is why financial educators consistently emphasize that investing in stocks is not gambling in the traditional sense. It is the purchasing of ownership in real businesses that produce real goods and services for real people, as outlined by Benjamin Graham in his foundational work, The Intelligent Investor. Now consider the mathematics of this over time. According to data from the Federal Reserve and Historical Analysis by NYU Stern School of Business, the U.S. stock market has returned an average of approximately 10% annually over the last century when accounting for reinvested dividends. That means that money left inside a diversified portfolio of stocks, untouched and allowed to compound, has historically doubled roughly every 7 years. This is not a promise of future results. Markets fluctuate and short-term losses are a normal part of the cycle, but the long-term directional pattern of the market has been one of consistent growth, driven by the consistent growth of human productivity and innovation. The deeper systemic reality is that the stock market does not exist in isolation. It is woven into the fabric of the broader economy. When businesses grow and generate profit, they hire more workers, pay more taxes, and produce more goods, creating a cycle of economic expansion that benefits society at multiple levels. Conversely, when markets contract, the effects ripple outward into employment, credit availability, and consumer confidence. Understanding this relationship, as economists at the World Bank have long documented, is what separates informed investors from those who react emotionally to every headline and market movement. This is why financial literacy around the stock market is not a luxury reserved for the wealthy. It is a foundational life skill. The people who understand how this system works are able to position themselves as participants in economic growth rather than passive bystanders watching from the outside. They are not necessarily people with more money. They are people with more knowledge, and that knowledge changes the decisions they make, the risks they take thoughtfully, and the wealth they are able to build quietly over time. The stock market has existed in various forms since the 1600s, when the Dutch East India Company became the first corporation to issue public shares, according to historical records from the Amsterdam Exchange. What began as a mechanism for funding trade expeditions has evolved into a global system connecting millions of investors to thousands of companies across every industry imaginable. And today, with access more democratized than ever before, the question is no longer whether the stock market is for you. The question is whether you are willing to take the time to understand the system well enough to use it wisely.